Stuff. Good morning, everybody. Hope you're all well. Welcome to our CeMAP Bootcamp live stream. Bootcamp, equity release, CeMAP, all things mortgages for you to enjoy. So welcome to a beautiful, actually it is a lovely day out there in Cheltenham today. I don't know where you are in the country or the world, but it's all good here. Everything's online, everything's tickety-boo, so we're going to get cracking. As always, ping me questions if you want to. Happy to answer them as we go along. It's been a really good week, actually. Been a really busy week for everybody. Autumn's kicking in, isn't it? Pretty horrendous way. I went to the autumn garden show at Malvern yesterday. Crazy place, but really enjoyable. But very windy, very wet as well. So we went around just buying stuff and looking at garden things. It was all good stuff, really. What I did notice, though, at the garden show yesterday was the demographics, the people that attend these things. Now, you know, I'm not going to start stereotyping people, but it tended to be the older generation, people that got time and gardens and all that kind of stuff. You know, not just the older generation, there are some younger people there as well. The older generation is what I want to talk about now. So what I want to do is talk to you about the later life market, and I think things are going wrong with the later life market. And I think it's not quite fit for purpose. And I want to talk about this really briefly with you. So we're talking about the later life market. So let's just put our little title up there for you. It is called the later life market because what I want to do is I want to take a look at this holistically. Now, holistically is a lovely word. I can't spell it unless I use a computer, but it means the whole picture, as you can probably appreciate. Holistically means the whole picture, allowing you to look at the whole area of that marketplace. And we're looking here at the later life market. Now, the later life market is a marketplace which looks at people, I guess, above sort of age 50 or so, who are looking to remortgage, mortgage, whatever it is. They're looking at taking out some kind of loan with their property. At the moment, we've got a later life market which consists of silos. This hit home to me the other day when I was running a workshop in London for some clients, and we had a number of people in the room. We had different mortgage advisors, mortgage brokers, IFAs, all looking to take the equity release exam and pass it. And there's one chap there from the south of England. He ran an IFA firm. It's been an IFA for donkey's years, this firm. He's level 6 chartered qualified. So this guy's like well qualified. And he was saying to me that a client came up to see him. I asked him why does he want equity release? He said a client came up to see him recently who is looking to get some money on their retirement. So they're in their sort of 60, 65 age. But they've got this huge pension pot. And because of where he lives, they've also got a huge property, but not a lot of income because they're just kind of thinking about stopping work. So not a lot of savings, so massive pension pot, massive property. Now, obviously, most people would go to the pension pot, start taking some kind of drawdown or whatever it is. And he decided that wasn't the best advice. He thought about taking equity release instead from the property to release equity, to release money, because you know lots of equity rather than the pension. And that got me thinking, because only IFAs are qualified to give that advice. So what we've got, you see, we've got 3 silos effectively in the later life market, which is quite scary. You've got your IFAs, qualified IFAs who give advice on pensions, investments, etc. They're starting to dabble in the later life market because this IFA felt that equity release was required. What you've also got, of course, is you've got your bog standard, if I can call that, mortgage advisors, there you go, who are qualified, CeMAP, CF6, whatever it is, to give mortgage advice. And they, of course, can look at RIOs now, which are retirement interest-only mortgages, but they can't look at anything else. And the final silo, of course, is the equity release advisor. There we are, equity release advisor, who is qualified to give equity release advice on all equity release products. But the problem is, you see, we've got this massive market of baby boomers. They're all at the Malvern County show yesterday. Big pensions, big properties, a lot of them, baby boomers, all growing up, retiring. And we've got this siloed market, and it's wrong, you see, because the mortgage advisor can't go across there, start giving advice on equity release. The IFA, of course, can't go to mortgage advisors or equity release. Most of them are mortgage qualified anyway. So you've got clients talking to this person here, only getting selected advice. Clients talking to this person, only getting selected advice. Clients talking to this person and only getting selected advice as well. Obviously, they can all talk to each other, we know that, and you can have a referral mechanism, but you know, I've met a lot of financial advisors, and what they don't like to do is refer. You don't like to lose their clients. You know, I was an advisor myself for many years, and you kind of don't trust others really, unless of course you've got a great relationship. I'm sure there's many exceptions to that. So what we need to do, and the FCA are looking at it as well, good old FCA, they're looking to combine these two qualifications into one, maybe up the ante to the level 4, which it needs to do really. I mean, the basic CeMAP CF6 is very low. I mean, it's level 3 qualification. It's not that tough really at the end of the day. So they're looking to combine it. So that will take a while though, but we need to combine it together. We need to have holistic advice. That's the drum. That's what we're going to start beating now, because that's really what clients need at the end of the day. So that's just a little idea for you how the equity release later life market is going. Great fun at the autumn garden show as well. What did we buy? We bought this rose thing, this pyramid thing. Lots of food. I bought some cheesecakes and some flapjacks, because lots of people selling stuff as well. Plants, of course, bulbs for the garden. Yeah, it's just good day, good afternoon, and just terrible weather. Hey, that's been okay for you. Okay, let's wrap that one up then, straight. Let's have a quick look where we're getting online. Get that rubbed out, and we'll get on to our main topic of the day for you. Now, the main topic of today, which I want to talk about, is suitability requirements. So let's get on to that, shall we? Let's flick that over for you. Let's take a look at a really important topic called suitability. And suitability is a massive area really of concern for both the FCA and compliance people, and absolutely it should be too. So I'm calling this suitability. There you go, here's the title. There you go, I think I spelled that correctly. Suitability. Now, I used to have arguments with my best mates at school. We used to play this thing called Top Trumps. You've probably heard of the thing, where you have a card and you have like a great big aeroplane or a car or something, and you had like 200,000 horsepower or machine guns or whatever, and you used to try and bet against each other who had the best car or the best aircraft. It was called Top Trumps. And a lot of people go around now with their phones, don't they? They've got the best phone going, you know. But what defines as best? And in the old days, back in the 80s and 90s, when the FCA or FSA at the time was created, we used to call it best advice. In other words, you had to give best advice to your clients. Best advice, of course, is a funny old concept, because what exactly is best? Nobody knows, do they? How do you define what's best? And obviously the FCA and the regulators wanted to make sure that clients got the best advice. So what they did in the noughties, they tightened things up quite considerably, and they said, well look, from now on we need you to give suitable advice, and you need to prove that. That was the big issue. That was the big issue. You have to prove it, that you've given suitable advice. And how do you do it? Proof's in the pudding, isn't it? So all advisors now, from now on, that's mortgage advisors, well, there is an exception there, which I'll talk about in a second, but restricted advisors, IFAs, financial advisors have to prove that they've given suitable advice to their clients. And it's absolutely vital you do that. And you need to create a suitable or suitability report, which gets provided. So suitability report, I guess, should be the title of this video. So let's take a look at that in a bit more detail, shall we, and see how that was. First of all then, what starts suitability? Well, the starting point to any suitability is a decent fact finding. There you go. Now I do a lot of work with clients who've got sales teams on the phone face to face, and I teach them how to do fact finding. Now fact finding on its own is a pretty straightforward affair, isn't it? What have you got? You've got a form, a series of forms, or you've got computer software, what it is, and you've got lots and lots of boxes in this fact find that people have to fill in all the details of the client. And that's great. That's not a difficult thing to do. But if you do it properly, of course, if you have a proper conversation, it makes it far more interesting. We can talk about that another time. But the big issue nowadays, though, is fact finding, which is facts, but it's not. It's actually soft information as well. So it's not just facts. It's a lot of soft information. It's done online now, and you've got technology to do this now. And if you haven't got this working for you yet, you need to get it. There's all sorts of computer software now. You've got this thing called open banking, of course. You've got a thing called APIs. I never know what it stands for. But what this stuff does, of course, is it gets you into the cloud where all your data's stored. APIs are a link system that allows a software to talk to another piece of software. And open banking allows you to connect yourself with your bank account to get all the data and details about your bank account. So what's happening now, these fintech gurus, these startup types, rather than fact finding in the good old fashioned boring way, they're actually just connecting to data. Very fascinating stuff. So you can actually do a fact find on a client in seconds. You don't actually do it, do you? Just press a button and zzz, off it goes. Gets all the data you need from the cloud, because everything about you is in some database in the cloud. We talk about social media, which has got a ton of stuff as well, of course it has. But there's tons of data. Amazon, Google, local authorities, land registry, employment details, HMRC, DVLA for your car. There's a ton of data out there, all in the cloud, which gives you all the information you need for fact finding. So that's all happening. That's the future. It's not happening yet. Now, the younger generation, of course, will embrace this very quickly on their apps. They expect a mortgage application and an approval in 2 hours. Back in our day, of course, it used to take 2 weeks or 2 months. In fact, it's still far too long-winded. So that's the fact find. You've got to do a proper fact find. You've got to get hard facts, soft facts, all sorts of information. And I love to have a good old 45 minutes to an hour conversation with clients to find out all about their needs and wants, desires, dreams, problems, challenges. That's the first thing. The next thing you do, of course, is once you've got your fact find done, you then produce the suitability itself, or the suitability report. Now, the suitability report is a report, a number of pages, some longer than others, which tells the client what is going to be the advice. It tells the client what the suitable advice is. Now, the biggest issue, of course, for suitability reporting is risk. Risk is the biggest issue for customers. But you need to take a look at why have you recommended the product. Risk is the biggest issue. That's the big one as well. Attitude to risk, you've probably heard of course. Attitude to risk is quite a common thing. That, of course, can be rated 1, 2, 3, medium, long term, or whatever. Attitude to risk is what kind of attitude you have to taking a risk with the product that's been recommended. We're not just talking about mortgages here. We're talking about all sorts of financial products as well. The big one, though, is tolerance to loss. That has to be found out by financial advisors in the fact finding. How much are people willing to lose? Now, I've got my pension in a SIP, a self-invested personal pension plan, and I'm in quite an adventurous fund because I kind of like it, really. But it's a bit more deeper than that. And one quarter, it gives me figures on quarter, I might lose money. And I've lost money, quite a few thousands. So you have to say, well, what's my tolerance to this loss? Am I willing to take a loss here? Because the next quarter, of course, it might go up again. And hopefully over a period of time, it goes up long term. So that's another key area that they like to ask you about as well. And the same thing for mortgages as well. But mortgages don't tend to lose, so they don't have a tolerance for loss. So, it's not really a massive area when it talks about giving mortgage advice, but it's certainly important for financial advice. So then the suitability report comes rolling along, of course. So let's take a look at the kind of things that the suitability report will want to have in it as well. Well, first of all, it must be clear, fair, and not misleading. It has to be written in language that people understand. I don't think many are, if I'm honest. I've read some and they're awful. They're written by computers and templated. Compliance people get hold of them and start putting big words in there and stuff like that, which is wrong. Now, take for example Donald Trump. I mean, you love him or you hate him. I'm not going to get into politics, but Donald Trump's very popular because he speaks the language that people understand. If you were to listen to his languages and his tweets, they're very simple words, simple structured sentences, very short, because people understand them very quickly. Whether that's right or wrong, I'm not going there. The fact is, people understand him. Now, the whole point is your suitability report should be understood by the customer. They should be able to read it, get it, and that's the whole point. Clear, fair, not misleading. Then it tells you why have you selected the product. Why have you selected the product or products for the client, and why not? In other words, which ones have you discounted as a result of getting there? So you might have recommended, for example, a fixed rate mortgage. So why have you recommended that, and why have you discounted a sort of a variable rate or a LIBOR linked rate or whatever it is? So you've got to take a look at the why, the reasons. Then you've got to look at benefits, risks, features of the product. They've all got to come in as well, haven't they? When does these get issued? Well, they get issued post advice. So once you've given the advice to the customer, so fact finding, we put that in there for you, advice, gets given, of course, and then the suitability report is then produced afterwards. There's no set time limit for it, and some companies require it in 48 hours, but that's entirely up to them how they do that. Now, for mortgage advice, of course, there's no actual requirement for a suitability letter. Not a lot of people know that, but most companies do, if not all of them, have some kind of suitability report. But they're always needed for life insurance, pensions advice, investment advice, and pension transfers. So they're always required for that. So you might find that as a question in the exam. That's pretty much suitability reports for suitability. Now, I think it's a great thing. Very difficult to prove though, isn't it? What's suitable, what's not. But at least we're doing something about it, and we're giving attitude and risks and all sorts of things as well. But I still reckon I've got the best phone in the world. And playing top trumps when I was a kid was fantastic. In fact, I had the best conkers as well. This time you get conkers, don't you? I actually had a 25er once in a conker. For those of you who've got no idea what I'm talking about, Google it. Conkering was best thing ever when I was a kid. We didn't have phones to tap away with. We used to play conkers and marbles and stuff like that. Yeah, enough of that. Suitability reports. Hope that's been useful for you. Bye. There you go. So hopefully you like that one. Hopefully that's been interesting for you. And a quick drink of my cup of tea to show you that it's live and kicking. We're going out on podcasts now as well. We've introduced a podcast of this on iTunes, Spotify, Google Play, and all those things. So if you don't want to watch the video, you can listen to the podcast, which obviously you don't get the whiteboard, I get that totally, but hopefully you'll get a lot of the information that I'm giving you along the way. Okay, let's move on to sort of a final topic really with you. I want to talk about, well, a couple of topics actually I want to give you along the way. This one's about peanut butter. Peanut butter. Now I love peanut butter, don't you? Peanut butter. Now, peanut butter is probably the most glorious thing you could ever eat on toast or bread or whatever it is. Apparently Elvis Presley used to eat peanut butter deep fried sandwiches. Maybe that's a bit of a fallacy. Probably what gave him his heart attack. An awful lot of calories, cholesterol, and peanut butter. Well, peanut's quite good for you. Now, the point I'm making here is that imports from the USA to the EU of peanut butter have plummeted in the last month or two. In fact, the figures for Germany, apparently Germans love peanut butter, I didn't know that. They were importing, just get numbers right, 1,000 tonnes of peanut butter every month at one point. That's a lot of peanut butter. That's quite a few container ships of peanut butter from the US. But last month it went down to 8 tonnes. So think about it. You've got 1,000 tonnes of this stuff going down to 8 tonnes in a month. So what's happened? Well, the biggest issue here is tariffs. Now this is just a little update for you on tariffs and how it affects your CeMAP. Now a tariff, as you know, you've probably read about it, is something which countries impose upon a import of a good if they don't want it to be released to the country with open competition. So for example, we might import from China or from Japan some cars. We might import cars from Japan. As they come through the import area, we might put a tariff on there of £1,000 or 10% of the price. And that's basically a tax, and the government collect that money. Now the US has got into a bit of a trade war, as you know. Donald Trump loves his trade wars. He's got trade wars all over the world at the moment. The China one's the biggest one, but he actually imposed tariffs on steel and aluminium from the EU to be exported to America. He wanted to preserve or protect the steel industry in the States. Now, of course, it's a war, you see, so people retaliate. So the European Union have retaliated as well. And we put tariffs on peanut butter for some reason, I don't know why. But so it's made peanut butter really expensive, that's the problem, which is why, of course, imports have come right down. Now, there's a big issue here because it's having an enormous effect now on the world economy, because China and the US are really going for it now on their trade war. And apparently every import from China into the US now has a tariff attached to it. So everything that's been imported to the US from China has got a tariff. In other words, the cost of that item is increasing. So of course, what happens when prices, this is your economic stuff now for you, what happens when prices of goods go up? Well, it causes inflation. Because prices go up, cause inflation. Now inflation, of course, is not a good thing. We have 2% targets here in the UK, so they do in the US, which means that if inflation is running at 2%, we're okay. If it runs above 2%, then the Bank of England start getting a bit nervous and do something about that. And what they do as you'd appreciate, is they will increase interest rates. There you go, interest rates. They will increase interest rates if inflation starts to rise above 2%, because what that does is it brings inflation down. And that's the best correlation that you need to know for your CeMAP examination. What else is happening, of course, other than prices going up, is we've got wage rises. Wages are increasing more than ever before now. We're in a full economy now, so wages are going up more than inflation. So what do increased wages cause? Well, they cause companies to have higher costs, obviously, and that's an impact on the prices, because companies put their prices up to offset increasing wages. Makes sense, absolutely makes sense. Which of course then increases inflation. So we've got a couple of things now increasing inflation quite dramatically now. And it's a little bit concerning and worrying, because we're in a boom economy, things are bubbling nicely, inflation's starting to trickle up. There's lots of underlying effects of inflation. And interest rates may well be combated. Now, the biggest issue we've got here, of course, is the downturn. There's talk of a downturn. There's various stats proving it. Call it a recession, call it what you like. Now, the downturn, of course, makes economies and governments nervous. And in the US, the Fed are putting their rates down. The Bank of England is talking about bringing our rates down. Well, what are we now, 0.75%? Can't actually go down very much than we are. So although we're trying to put interest rates up to combat inflation, the downturn means interest rates might come down. So we might see inflation starting to rise. So look for your fixed rate mortgages, really, which is the key. Fixed rate mortgages cost 5 years. You can get 10, 15-year fixed rate mortgages now. Very low rates. Definitely want to fix those as quickly as possible, because inflation's rising. It's going to take a long time before these trade wars start getting sorted out and peanut butter comes down in price. And so a little bit of update there for you on economics. So that's been useful. I love peanut butter, don't you? It's glorious stuff, isn't it? But I don't eat too much of it because it's not good for you. At my age, you can be careful of the old ticker and all those sort of things. So enough of that. So a little bit of update for you on inflation, interest rates, and the peanut butter connection. Bye. Okay, you lose that one. That was enjoyable for you. Enough of that on peanut butter. Good, great. I think we're going to wrap things up. It's 25 past 10. A little bit of update for you on a few things. Hope you found all this useful. We're going to talk to you again next Monday at 10 o'clock, timing allowing. And remember, we're on podcast now, we're on video, YouTube. Sign up for my YouTube channel, that's paularcher.tv, if you're watching this somewhere else. And you can get it on iTunes or get the podcast, just Google Paul Archer or CeMAP Bootcamp, and you'll be able to find us on there for you. We'll see you next week. Bye.